All right, let's jump right into a question that sounds completely upside down. What if I told you that when prices get way too high, the government's big solution isn't to give you more money, but to actually take money away? Yeah, it sounds totally backward, but believe it or not, it's one of the most important ideas in our entire modern economy.
So, you know the feeling, right? You go to the grocery store, you fill up your car, and everything just costs more than it did last month. Prices are just shooting up across the board. Now, you'd think the logical response would be, okay, let's get more money into people's hands so they can afford things. But the people in charge, the central bank? Nope, they do the exact opposite. That's right. They have a system designed to intentionally pull money out of the economy. It seems totally counterintuitive, maybe even a little harsh, but there is a very, very specific reason they do it. And that's the big puzzle we're going to solve today. How on earth do they pull this off? And more importantly, why would making money scarcer be the answer to rising prices? Let's get into it. Okay, so before we can understand any of this, we have to get one foundational idea straight. And that's the fact that not all money is really created equal. We got to talk about the difference between the number you see in your bank account and what that number can actually buy you out in the real world. So on one side, you have what we call nominal money. This is the easy one. It's just the number on the bill. A $20 bill says 20 on it. Simple. But on the other side, you've got real money. And this is what actually matters. This is your purchasing power. I mean, think about it. If you have $1 million, but a loaf of bread costs $1 million, are you rich? Not really. And here's how the math on that works. It's actually super simple. Your real money supply, your actual wealth, is the amount of money you have divided by the average price of everything. And that's the key. When that number on the bottom, the price level, goes up faster than the number on top, your real wealth is actually going down. That is inflation. So what's the big red flag for the economy? What's the alarm bell that tells the Fed that prices are getting out of hand? Well, they're not looking at the price of your morning coffee. They're watching commodities. We're talking about the basic raw ingredients that our entire economy is built on. And you can see here how it creates this massive domino effect. When the price of oil goes up, it's not just that gas is more expensive at the pump. It means it costs more to ship everything, which makes every single thing on every shelf in every store more expensive. When wheat goes up, it's bread, it's pasta, it's cereal. You get the idea. Commodities are like the economy's circulatory system, and when inflation gets in there, it spreads everywhere. Fast. So when economists see the price of all these fundamental things spiking at the same time, it tells them one very specific thing. The balance is broken. There is simply way too much money sloshing around the system compared to the amount of actual stuff available to buy. Okay, so we've got the diagnosis. Too much money chasing too few goods. So what's the cure? Well, the government has this powerful financial machine it uses to suck that extra money right out of the system. Let's break down how this whole thing works. The whole process is actually pretty ingenious. So step one, the Fed starts selling government bonds. Think of these as just an IOU from the government. Step two, big investors like banks and giant investment funds buy these bonds. Now here's the magic trick. Step three, when they pay for those bonds, the money they use literally vanishes from the regular banking system. It gets sucked into the Fed. So now the banks have less cash on hand. Because there's less money to go around, they have to charge more to lend it out. Boom. Step five, interest rates go up. And when interest rates are high, getting a mortgage or a car loan gets more expensive. So what happens? People and businesses borrow less, they spend less, and the whole economy starts to cool down, which puts the brakes on inflation. Honestly, the best way to picture this whole thing is to think of the economy as a bathtub full of money. When inflation is high, the tub is overflowing. By selling bonds, the Fed is literally just opening the drain, letting that extra money flow out until the water level gets back to a manageable place. It's that simple. Now you might be thinking, has it always been this way? And the answer is no, not even close. This whole system of actively managing the money supply is pretty new. To really get why we do it, we got to take a quick trip back in time to see what things were like before, when the financial world was basically the Wild West. For most of America's history, our money was directly tied to gold and silver. This was good for keeping a lid on things, but it was also super rigid, and the system was hit by one banking panic after another. The breaking point was the huge panic of 1907. It was so bad it almost took down the entire U.S. economy. And right after that, everyone basically agreed, okay, we can't do this anymore. And so, in 1913, the Federal Reserve was born to act as a manager for the whole system. Now, to be fair, the old gold standard wasn't all bad.
It had one huge advantage. Over the really long run, inflation was super low. But the downsides? They were pretty terrible. Recessions were absolutely brutal because there was no one to step in and help, and you had these constant bank runs that kept a system perpetually on the verge of collapse.
And that leads us to the big idea at the heart of our modern economy. When we switched from that old system to the new one, we made a conscious choice. We made a trade-off.
This chart lays it out perfectly. Before 1913, under the gold standard, we got long-term price stability. But we had to live with constant, nasty financial crises. After 1913, with the Fed, we get fewer and less severe crises and a lot more flexibility. But what did we give up? We accepted the permanent risk of inflation. We basically traded one type of problem for another.
And that brings us right back to where we started. The entire reason the Fed sells bonds to fight inflation today is because of this one simple, inescapable economic law. If the amount of money in the system grows faster than the amount of real stuff, cars, food, houses, then the prices for all that stuff have to go up. There's no way around it.
So the next time you hear on the news that the Fed is selling bonds to fight inflation, you'll know exactly what's going on. They're just draining the bathtub. It's not about politics or somebody's opinion. It's just math.